Hey, welcome to Stock, Stack, and Beer, where we grab a cold one and talk about the stock markets and technology. And today we're going to talk about one thing and one thing only, and that is SPACs, Special Purpose Acquisition Companies. Now, regular viewers have heard me talk briefly about these low-risk, high-reward investment vehicles, but these trade a little bit differently than a normal stock like Apple or Tesla, so it's caused a little bit of confusion. I've got some questions about this, so I hope to set the record straight today and make sure everyone is on the same page and knows how to invest in these SPACs. But first, as always, let's talk about our drinks. Oh yeah, if you don't like this part, you just skip forward to the next chapter. I put it in there for people like you. And disclaimer time, this isn't financial advice. Just a guy here drinking a Coors Light. Short story in a minute. But, advice is free. You pay what you get for, and you got to do your own homework, really. So that's the disclaimer. And now into the beer. Since I'm traveling in Colorado, I'm in Breckenridge this month, high up in the Rocky Mountains, and I figured up here I should be drinking some Coors Light since it's brewed here, see if it tastes any different, tastes any better. It's still icy cold, but the flavor is still the same. I mean, it's not a horrible beer. You know what you're going to get every time you get a Coors Light, and we'll give it a 4 out of 10. It's not bad. All right, now onto the info. So SPAC has one sole purpose, and that purpose is to acquire a private company that it wants to take public. So SPAC is publicly traded. That's how we can own the shares. And I said acquire in quotes because it doesn't really acquire the company. Management stays the same. The business plan stays the same. The only thing that changes is that it's publicly traded. So knowing the sole purpose of the SPAC is to take the private company public, I'm now going to give you some terminology. And the first term we need to talk about is the sponsor, and that's the person or company that is going to take the company public. They're the ones that are going to put the SPAC on the public markets, and they're going to be backing it. They're going to be doing the work to get it done. The sponsor is special to the process. We're going to talk a little bit more about the sponsor in a minute. So first, the cash raised in the IPO of the SPAC will sit in an account waiting for a deal to happen, and that's really the only business operations of the SPAC, is just holding cash in an account. And typically a SPAC has 18 to 24 months to go out and find a private company to take public. If it doesn't succeed in this, they are obligated through the charter of the company to return the money that the investors put in back to the investors. So it's kind of like a cashback guarantee for the investors if it doesn't work out. And that's why I say it's a low risk return or low risk investment for us that we can make, because we know what our minimum is. It's going to be $10 a share, maybe a little bit less, because it's going to take out some auditing fees and legal fees, and no one's earning a lot of interest these days. So you're going to get close to $10 back if it doesn't work out. So as long as you don't pay too much for the shares, you're going to get your money back. Now, I like to buy SPACs almost as soon as they IPO, because when you do that, you get you don't get shares yet. You get what are called units. And what a unit is it consists of two things. It consists of one, a share of the SPAC, which you'll get when you split the unit up. And the other thing you get is usually a fraction of a warrant. And a warrant is a right, but not the obligation to buy a share of the company by a future date at a certain price. So the SPAC, typically if it IPOs for $10 a share, which most of them do, the warrant will have a strike price of $11.50. So a warrant's only going to be worth something if a deal gets affected. If the deal doesn't happen, it's really, really unlikely that the shares will have, that the cash in the bank is going to grow from 10 to 11.50 for everyone. It's just not likely. So those warrants will expire worthless if a deal doesn't happen and the investors get their money back. But if a deal does happen, you essentially get twice the upside you would if you just owned the shares, because you get the warrant to kind of push up the value of the price as well. So warrants are a pretty cool feature of the SPAC unit. So the unit consists of shares, warrants, and that's really what you need to know there. And now let's talk about the sponsor, because really it's the sponsor, it's a management team behind the SPAC, and they typically put up some capital and they do all the work. So they're sponsoring the investment, they're sponsoring the company coming public, and that's why they're called the sponsor. Now, this isn't an altruistic thing that these sponsors are doing. I mean, really, they're in it to make money, and they can make a lot of money in this process. Because typically, when they do this, they get what are called sponsor shares. And you can read about all these terms in the S1 for each of these SPACs if you really want to get dirty, deep and dirty in there and see what is going on and all the terms behind it. But that's kind of boring stuff. Leave that to someone like me who's part of their day job to go through and read those documents, and I'll pass on the information to you. But I mean, in some cases, these SPAC sponsors, if a deal happens, they get 20% of the company going public. And they don't put in a lot of money. Like usually they pay $25,000 or so for these sponsor shares. It's really a nominal amount. It's not really important in the scheme of things, the material. But if a deal happens, they end up with a lot of the company. Sponsors also buy a good chunk of warrants as well, usually, and that helps offset some of those legal and accounting fees I was talking about. And it gives them even more of the company if the deal happens. So I mean, as you can tell, sponsors get rich by the process, so they can bring a company public through their SPAC. So that's one of the big reasons we've seen the rise in SPACs in the past year, is because the sponsors realize what a gold mine it can be for them, and the private companies are realizing it's easier, more fair process, and they get a better valuation, and it's quicker to go through the traditional IPO process. Now, once you buy units of the SPAC, you're going to have to do one more thing to make sure you can hold on to this investment. And that is typically around 50 days after the unit IPOs, you're going to have the option to split the unit into the shares and the warrants, like I mentioned. That's something you're definitely going to want to do. I've noticed a couple of recent SPACs have had this happen automatically, but I have had to call my broker for a few others to direct them to split the units into the shares and the warrants. And just be aware, it usually comes with a $39 corporate action fee, at least in both of the brokers that I use, and I've heard from other people that they have a similar fee in their account, even if the split happens automatically. So you don't want to just buy like 5 or 10 shares of these. You want to make sure you can get a decent amount of shares so it doesn't eat away at your total profits. And that's another thing to worry about with the share count. When you get a fractional warrant, so like let's say you get 1/3 of a warrant, you want to buy in multiples of 3. So don't buy 100 shares, buy like 99 shares or 102 shares. Or really, you should be buying like 300 shares or more, because if you're not doing more than that, I don't know if it's really worth the time. I mean, 100 could be, 100 shares, $1,000. I'd say you probably make about 30% on average when a deal happens, so that'd be $300. So I guess 100 would be okay, but really the more the better. And like I said, I feel they're fairly safe. I got a lot of my personal money in these SPACs right now, and I feel comfortable knowing that there's that money in the bank providing the floor for the SPAC. So be sure to have a good number of shares, and if you don't have enough to buy like at least 100 shares, like I said, work harder, save up some money, and wait until you do, and it'll be a quicker process for you to grow your money. And after that, you really just sit and wait. Or there's one more thing you could do, and it's just kind of like an advanced move, a selling strategy you could think about. So once it splits, you can hang on to both the shares and the warrants if you want. Or what you could do is, if these shares are now valued at more than the unit you bought, which does happen if you buy the unit close or at the IPO price, you could sell the shares, take all your money out of the trade, and then you're holding on to these warrants as a risk-free lottery ticket. And it can pay off. It just happened to me the other week. I did this with Novus Capital. It was a SPAC I bought a month or two ago, and split the unit into the shares and the warrants. Sold the shares for more than I bought the units, and I was just hanging on to a couple hundred warrants. And just a couple weeks ago, they agreed to merge with App Harvester. It's an indoor farming tech company. But anyways, it shot up right away. It went up around $13, $14 a share. I dropped those warrants like they're hot, because a lot of times you see excitement go out as you see people buy into the SPAC shares right when the deal is announced. And a lot of times you see a spike and you see a pullback, and it did pull back on me. So I'm glad I got out. And to be honest, to hang on to these warrants or shares, you'd want to make sure you know what App Harvester is all about, its valuation, how big you think it can grow. And I don't know if they have a lot of filings out about that yet, so you have to wait until there's more filings released about the company that they're bringing public. And once you see those filings, then you can decide if you want to get back in. And sometimes after you get back in, you get a monster run like Virgin Galactic or DraftKings. Those things have just soared. It would have been great to hold on to. So that's the basics of the SPACs right there. You have the sponsors or the people that are doing all the work behind the scenes. And you don't really need to know that to invest in a SPAC. It's just kind of good to know in case you get into the S1 and want to see how it's structured. But you need to know as an investor, really the most important part is you want to get in right away and you want to buy the units. And then eventually, when you're able to, you want to split the units into shares and the warrants. And that's really what you need to know. Those are the important things to do. And from there, you just hold tight, wait for a deal to happen, and profit.